Hi, finance experts. I chose to do my financial analysis on the airline industry, the automobile industry, and the information technology industry. First, we're going to start off with the airline industry. I chose to look at Delta, United, Allegiant Air, JetBlue, and Southwest. Immediately upon starting to check into the industry, I noticed that 2015 was an excellent year for airlines. So I turned to the news and I tried to figure out exactly what had happened there. It turns out that 2015 was an abnormally great year for gas. The prices were just crazy low per barrel, and the airline industry did not share those costs with the cost savings with their customers, so they continued to charge the same amount of per ticket, and they were able to make astronomically large profits during that year. What I had seen, here are some of the charts. This is the long run and the short run. In the short run, their short-term ratios are pretty unimpressive. It shows that they're not really able to meet their costs in general. You can see in the long term, most likely because they have very high levels of debt associated with large fixed costs like airplanes and stuff like that. So the entire airline industry kind of proved to be relatively unattractive for these reasons. My favorite company of the industry was, however, Allegiant Air. They had significantly better than average short-term ratios, which the short-term ratios on average seemed to look less than 1. So they had less than something like 70 cents for every dollar of debt that they had. Allegiant Air was able to at least cover these costs, but still, they were still in dangerous zones for investing. Anyway, as you can see here, these are Allegiant Air's profitability ratios. This is their profits, and you can see that abnormally large high spike in 2015, and this is their market value ratio. They also had a significantly better market value ratio than some of the other companies. That is just another one of the reasons why I chose Allegiant Air over the other airline industry companies that I chose to analyze. The second industry that I chose to look into was the automobile industry. I looked at Ford, Daimler AG, Honda, and Kia. Before I start talking about it, I just want to come up so you can see the data that I'm going to be analyzing. Their short-term solvency ratios were better than the automobile industry, which was good considering they are still also dealing with large fixed assets, not quite planes, and still cars. It's still a lot of fixed assets. So their short-term ratio, the cash coverage, was what was a major issue. They still did not, as an industry, did not really have the cash to cover their debts, which is another thing that's incredibly alarming as a financial expert and a potential investor. Their long-term ratios were kind of all over the place. The cash coverage showed the same as the cash ratio in the long run as it does in the short run. They're very desperate for cash, and it seems that they have very, very large amount of debts, which does compare to the airline industry in that way. Something that I thought stood out in the automobile industry was its EVA. As you can see, those are all negative numbers. It just goes to prove that the airline industry, since 2013, has been struggling significantly. It would appear, just from the numbers telling a story, that the automobile industry is suffering some sort of recession or depression type situation where they are not selling as many cars as they once had and making the stocks associated with these companies even less attractive. It seems that people are maybe, buying used cars and not buying new cars, and so more cars are just sitting on the lots as opposed to making new purchases. This also hurts the industry as a whole. My favorite industry of the companies, or my favorite company of the automobile industry that I looked at was Tesla. There are many reasons why Tesla was my favorite company, and I will go ahead and review them for you. First, the Gigafactory. It's pretty new. I guess they announced it 2 years ago about how they would be building the largest factory in the entire world. This will be to kind of offset and minimize their fixed costs associated with mass producing batteries. And so this will help them automate their process even further and make it to the point where they're not really relying on other people as much as they have been to import the stuff that they need for batteries and such. Their ratios are pretty alarming. It's definitely undeniable to say that Tesla does not have some pretty questionable. The numbers do tell a story, and they definitely have some pretty questionable ratios, such as the cash ratio and cash coverage ratio associated with their debts. Because I would say largely in part of the Gigafactory and how the scope really of the dream that they are trying to tackle. They do have a very redeeming price to equity ratio, though. It does seem that interest in the stock is growing tremendously. It seems that that people are still really trusting the company despite what the numbers and the story that the numbers might be telling. Investors still feel very strongly about this company. So investing your money in this company based on the price to earnings ratio does seem that it would be a lucrative investment. But with that is high risk. As we talked in class, is the risk to reward ratio. There could potentially be a lot of high rewards for this if the Gigafactory were to pay off and you were a potential investor, then, I mean, that would be very lucrative for you, but you are running a very high risk situation in investing in it. I think I'd be doing a disservice not to mention one of the major reasons that investors are so excited about Tesla and so willing to give up money despite what the numbers may look like, and I think that Elon Musk is worthy of note. He is a very successful historical businessman. He has been able to bring many firms from absolutely nothing, and he has built many companies into Fortune 500s, and so he has been able to do this multiple times, proving that he is more than capable of running a successful company, tied with the fact that he is offering an element of hope. He is selling something that many of the other companies in the industry are not selling. Not only is he involved in selling things like solar panels and solar paneled roofs and all kinds of stuff. He's associated with SpaceX, which is trying to put people in a colony on Mars inevitably, and just recently they put a Tesla car into space. So I think that he's a major part. He's inspiring people to think brightly about the future. He always challenges people to, people ask him why he does what he does, and his answer is actually pretty simple. I want to think about a tomorrow that is happy and bright, and there's something to look forward to, and that is the brand and the image that he sells for himself, but also as the CEO of Tesla is something that he is promoting on into the future with the company. So I think that his affiliation and obviously position with Tesla is extremely beneficial to the company, and you can see that through the price to equity ratio. I did briefly touch on it, but another major reason that I did choose Tesla was because they actually are in a little bit of the solar panel industry, or they are in the solar panel industry as well as doing automobiles. And with recent events like imports on tariffs, I do think that they will be able to capture a larger part of that market in the U.S. Solar panel sales. So I do think that that will be something that will be coming to Tesla very soon, and will be very lucrative for their company and their investors. The third industry that I did was information technology. I looked at Samsung, Google, Apple, Amazon, and IBM. Here are some industry numbers. So, for the first time, these are some great looking numbers. The short-term ratios are excellent. Everything's above 1. Some things are at 2. Their long-term debt cash coverage is excellent. Their equity multiplier, all good looking numbers. Everything is just very impressive in this industry. You can tell that in recent years it has been really taking off, and all of the companies in this industry, since they have low fixed cost, unlike airlines and car industries, they don't really have the fixed assets, so they have much lower long-term debt, and so that has been very lucrative for them in the long-term debt situation. And seeing that they're being able to keep up with their short-term ratios is crucial, because since they have such low long-term debt. So my favorite company, which was not by any means a close competition, was Google. Here are some ratios. Their short-term ratios are just, incredible. They're actually so strong that one might criticize that they're too high, that they're not using enough of their available cash to expand the company. That would be the only complaint. It's not that they can't meet their debts, it's not that they can't pay out their shareholders. It's simply the fact that they're potentially holding too much cash. Their long-term ratios are, it looks like Google in particular, unlike the industry average, has been taking out more long-term debt than their other competitors. But obviously, looking into Google, they're starting to branch out into other things outside of information technology industry. So I would imagine that a lot of their long-term debts are affiliated with that situation. But even still, the numbers look good. No really issue there. Some more numbers that I wanted to share with Google is this. Their enterprise value has just gone up tremendously in the past 5 years. Their enterprise value literally goes like this and off the charts, and it is significantly higher than the industry average. They are by far the most trusted company in this industry that I analyzed, and you can tell based on the numbers. So that for those reasons, that is why I chose Google as my favorite. So Allegiant Air. So I will go on to compare my top 3 favorites. Okay, so Allegiant Air and Tesla was kind of a tough one, right? Because we're talking about a company that sells solar panels in cars. We're talking about airplane flights. So they're kind of different in a lot of ways, but they're also kind of similar in their fixed assets and cash coverage, current ratio, quick ratio type of ratios. So the Allegiant Air does have significantly better long-term ratios than Tesla does. That is largely in part due to the Gigafactory that I had mentioned earlier. Which, if the company is successful, they will inevitably pay that off, but that's not for our discussion today. Their asset turnovers are very similar. Profit margins, Allegiant Air is doing significantly better. Tesla has some alarming profitability margins. They seem to be not meeting their goals as well as they would like to. I would believe that is largely in part of the depression car depression. The automobile depression era that we were having at this time. I think that if that were not the case, then we would be seeing more Teslas being purchased, but that does not make an excuse for the numbers. They're telling a story. This is what's happening, and this is how the market is reacting to these situations. Like I told you, Tesla has a great price to equity ratio, which is better than Allegiant Air's, and their enterprise value has more than quadrupled in the past 5 years, whereas Allegiant Air's has barely doubled. So after fully analyzing all the numbers and considering the different factors like Elon Musk and his inspiration and how he inspires a society and a new tomorrow, I had to go ahead and go with Tesla as my preferred company over Allegiant Air and Tesla. I chose to do this not just because of Elon Musk and his inspirational mindset for the future, but also for their ambition if the company is still around in 10 years, they will have a fully functioning gigafactory that is able to process millions of batteries in record timing and would be able to be a world leader in battery production, which could potentially lead to be the future of the energy crisis in the world. So it would be a major thing for not just Tesla, but also for humankind. So I could not pick Tesla between this comparison. So the second comparison I had to make was between Tesla and Google. And despite, never mind. Okay, so the short-term ratios aren't even similar. I mean, Tesla's are significantly smaller than Google's. Long-term ratios, Tesla looks bad, Google looks great. Asset turnover, they are relatively similar. Profitability, Tesla looks really, really bad, and Google looks really, really good. The price to equity is good for really both of them. The market to book ratio for Tesla is significantly better than Google, and you can tell that you can kind of see the story that the reason that Tesla has a better ratio is because the investors, the price to equity ratio is because the investors truly do believe in the future of the company. They do believe in the what they could potentially bring around for the entire world. Not that Google's not that, because I don't think that Google investors feel like Google's not doing the same thing, if not successfully doing the same thing. But it seems that since the stock has increased so dramatically with quadrupling their price, their economic value for Tesla over the past 5 years, I think that Google has held very strong for significantly longer than 5 years, so there's not as much hype and excitement associated with their companies, so that is why the market to book ratio is not as good as Tesla's. But other than that, it's really no comparison. Google is the significantly stronger and more profitable company between these two, and definitely the more sound investment when you gauge risk and return. So my favorite company of all the companies that I analyzed was Google. I talked a little bit about their numbers, but here is some more just off the charts data. Their total asset turnover, like I said, literally straight for the moon. Their enterprise value, like I said before, has gone from, in 2013, 300,000 to 600,000, so more than doubled, and in such a short amount of time. So their companies and their investors know that this is a sound investment, and that they are if they're putting their money into Google, that they will be able to see their money back eventually, or that the company will continue to grow, and that their stocks and their value of their investment will continue to grow with the company. Their price to equity ratio is definitely not bad. The only thing that I could see that was kind of like, as a potential investor would be the fact that they didn't really have high dividend payouts, which is obviously good and bad as an investor, whether you're going to be a short-term or a long-term investor. In the short term, obviously, small dividends would not be attractive to you. But in the long term, sticking with a company that is reinvesting all of their cash and all of their assets back into the company is definitely ideal. And so that is why Google is my favorite company. And thank you for helping me become a finance expert.